And let's replay that just one more time. Okay, it's on the 3rd, which is right here at 2 o'clock. Perfect. Right there. Okay, now instead of just buying this because we had $1,100 drawdown, we are going to buy one. And the Russell 2000, we say, look, you know what? There's a lot of fluctuation in the NASDAQ 100. We were down $1,100. We're up $1,100. There's a lot of fluctuation in the price chart. It's very volatile. It was a little scary because at one point we were down $1,100. We didn't know if we should get out or take the loss or just wait. If we waited, we would have been up $1,100. We ended up with $700 profit at the end of this. Let's do this. Let's hedge the long position that we have on the NASDAQ 100 with the Russell 2000. And in this case, we're going to sell 2 contracts. So there is a specific reason for that. And it has to do with the notional value of the contracts. But I'm not going to get into that right now. It's a little bit more complicated. But if you wanted to hedge your long position on the NASDAQ 100, then you hedge it with 2 contracts of the Micro E-mini Russell 2000 contracts. And we're going to play them at the same time, and let's see what happens. All right, let's pause it right here for a second, if I can. Okay, we didn't hit it exactly. At this point, we're actually up on both contracts. We are short this Russell 2000 contract, and we're long this one, and we're up $170 on this one, and we're up $460 on that one. So we are actually trying to protect our long position by shorting 2 of these contracts, and we're up on both positions. Okay, this is what hedge funds do in order to make money. They realize that, you know what, if we just go long in one direction with one index, we have a lot of risk because that can fluctuate dramatically from one period to another. Let's hedge it. That's where the name of the funds come in, a hedge fund, because they're hedging it with another index by shorting that index and having a long position and a short position in the market at the exact same time. All right, let's continue and see how we do. So our short position is still making money, but we're losing money now on our long position. But we're making a lot of money on our short position here. We're up pretty significantly, $1,700 here, and we're down $600 on our long position. So if we pause it again, if I can, we're up $1,700 on our 2 short contracts here, and we're down $700 on our long contract. So at this point, we are both long and short the market at the same time, but we've made $1,700 on our short position. We've lost $770 on our long position, giving us a net profit of about $960 or so. So not quite $1,000, almost $1,000. That's the power of using hedge fund strategies in your account. Now, as I mentioned, one of the reasons why it's very difficult for hedge funds now to generate outsized returns, those 30, 40, 50, 60, 70% returns a year, is because of the law of large numbers. But you are small. whether you have 50,000, 100,000, 200,000, 500,000 to invest, you're small enough to be able to get in and out of the market very, very quickly. Almost like, it's some, there's, I'm not sure exactly what the analogy is here, but let's say you're smaller than your opponent and you're playing, let's say soccer. Well, if you're smaller and lighter and they're heavier and stockier, you're going to be able to run rings around them and be able to move the ball quicker and get up the field faster than your opponent can, because they're heavier. Let's say he weighs 280 pounds and he's like 6'4", and he's like really, really big, and it's difficult for him to move around. And you're like 180 and you're thin and you're fast and on your feet. You can move much quicker, so you're going to be able to move around him very, very quickly and be able to pass the ball to yourself to make the goal. So this is basically the same idea. You're small enough to be able to make outsized returns using those hedge fund strategies that work so well for the hedge funds in the past, before the law of larger number came into effect for hedge funds. So basically now, because of the technology changes over the years that have now made those hedge fund strategies that were back in the 70s and 80s available to them to make outsized returns, that only they had technology that could access these strategies. Now you have these available to you. And so let's continue and see how we do. So we could have taken our profits right there, but we're going to let it continue. And we still have a fairly decent return on this side, about $1,400 now. We still have $1,800 profit there, $500 loss here. And let's pause one more time. And now we're only down $250 on our long position, and we are up $1,635. So now we've gone from about a $960 profit all the way up to $1,633 profit. Okay, so let's continue and see how we do. Let's pause here again. Now, all of a sudden, we're up $600 on this position, and we're up $1,800 on this position. The whole time that we've been in these positions, we've hedged it. We're short the market and we're long the market at the exact same time. Now we're up $2,400. And at this point, if you have a profit on both contracts, you might at this point want to take your profits and just leave. However, let's just play this out until today's date. And let's say we just said, hey, you know what? We're just going to let it go and see what happens. But at this point right now, you have $2,400 profit, and that's a very decent profit. Now, we have strategies specifically to help you know when to get into positions and when to get out of these hedged positions. And so that's exactly what we teach. Now let's continue and see how we do.